Hi, everybody. It's Dr. Robinson. This is the September 23rd, 2023 meeting of the Money Masters Investment Club. So we're just going to talk about three charts today, including this one. So let's get started. The first chart, or the second chart technically, is our NAV chart. So as of 9/22/23, our NAV is currently at $34.71. Again, we had a relatively good week this week, so I'm pretty pleased with our performance. The market remains slow, but it is consistent. So we had to strangle a couple of trades this week, but both times we exited the trades with profits. The market is really slow, and sometimes when the market is so slow, you can get candles going in the opposite direction. You're not really sure what to do with those. So the better part of valor sometimes is to strangle it early or to exit the trade. This week I just chose, instead of exiting the trade, I just chose to strangle. So, but each time I did it this week, it worked out okay. I'm not saying we made a lot of money. I think in one of them we only made $1,500, which was kind of an amazing thing. And you don't think of $1,500 as being a lot of money, but in that trade we had originally bought some calls, and we ended up losing like $82,000 or $92,000 on the calls. And as a backup, I bought some puts, and we made about 93 or 94,000, about $1,500 more on the puts. So it's kind of a very fast trade, kind of happened really quick. But some days, and the purpose of a strangle, as you guys have been told, is to get out of the trade without losing our shirt. So we kind of break even on a trade. That's all I'm trying to do. And then, of course, we wait for the next trade to come along, and we made money thereafter. But that first trade that day, not a great trade, only made $1,500. But when you're down $90,000, I'll take $1,500 profit on that trade. The market remains very volatile in the early morning. Then it calms down a lot after 10:30 or so. So after 10:30, though, the market moves at a snail's pace. And one of the things we're struggling this week is how long to hold a trade, because we're trying to use these, or we are using these longer charts, and the charts will support holding the chart or holding position, but the market just moves at a snail's pace. Or a pace. So as we wait for a trade to develop, it can sometimes take anywhere from 15 to 20 to even 30 minutes to get really 20 or 30 cents in this trade. The chart still holds, so it's not like we're under stress or anything. It's just we're used to that happening a lot quicker than it is right now. So I'm hoping that maybe that'll pick up here. The VIX has started rising a little bit. It did hit 17 this week. I think it ended up a little bit over 17 for the week. It's been bouncing around all week, and just in the last 5 days, it's bounced everywhere from 13 and a half or so up to about 17. And you guys know, of course, we prefer the longer or the higher VIX. Gives us more volatility. We like the volatility. Options traders need volatility, as opposed to traditional investors who don't like the volatility in their retirement accounts and things. But the VIX is rising, so I'm kind of hoping that we can take advantage of this in the coming days. We did have the Fed meeting this week, by the way, guys. So if you don't know that, the Fed left rates unchanged for the week. But Powell's comments after the meeting were actually quite hawkish about holding rates higher for longer. And this panicked the market. We saw some steep sell-offs late in the week. So Thursday and Friday, and even a little bit on Wednesday after his comments kind of settled a little bit, it unnerved the markets, and we saw the markets sell off a little bit. I think that's going to continue a little bit into the coming weeks, and maybe even into the we normally talk this year about the Santa Claus rally that's coming up, where everybody gets in a better mood and the markets tend to go up, where we're looking for how much money people are buying or spending on Christmas presents and stuff. But I don't think we're going to have a huge Santa Claus rally this year, at least for now. And again, it's still really early. We're not even in October yet. But it's not looking good for any type of Santa Claus rally at this point. So I think the market will probably continue to go down a little bit, because his comments really were unsettling to the market. But it's not like the market hasn't been told time and time again that the Fed was serious about holding rates higher for longer. In fact, in the meeting, guys, he did mention that he kind of wants interest rates, or implies through their dot plot. And we're not going to talk too much about the dot plot here. I'm not a big fan of the dot plot, the Fed's dot plot. But their dot plot does imply that interest rates will be probably at the high about 50 basis points higher than where they're at right now. And right now they're at 5.25 to 5.5. So that implies that they might go to say 5.75 to maybe 6.25 or 6 or something. So the rates could go higher from here. I'm not going to speculate on when I think that happens. I do still think that there's an interest rate hike on the table for November, but we do get some good information between now and then, of course. And of course, the Fed just had their meeting, so we're still 45 days out from their next meeting. They hold their meetings every 45 days or so. So there's a lot of data that can come in before then to kind of tell us whether the Fed is going to actually raise rates or lower them. In fact, next week we get the PCE numbers, which is the personal consumption expenditures, and that's the Fed kind of go-to number when it comes to inflation. So we know that the rates are going to go higher. They've kind of implied. I don't know when. But the other side of it is they did say that it was going to be higher for longer. One of the comments from one of the people in the meeting, by the way, said that rates could be higher well into 2026, guys. So we're not talking about just 2024, 2025. They're talking about rates maybe staying higher into 2026. Now, that's way too long for anyone to really make any kind of statement about where interest rates are going to be. That's kind of, to me, it's a little bit unreasonable. In all honesty, nobody knows where interest rates are going to be 6 months from now. So to go out a year and a half or even 2 years is kind of a little bit ridiculous. But at the end of the day, it did startle the market. The market has believed that the Fed was going to allow interest rates to come down. In fact, a lot of people really expected this year or maybe first quarter of next year that interest rates would start coming down. And the reason they believe that is because interest rates right now are so high that it is impacting, or it's going to start impacting very soon, the economy. And we're going to start to see GDP coming down. Now, GDP is actually doing pretty well right now. Economists are kind of a little flummoxed about why that is right now, because there are some people getting laid off. And we're starting to see some increase in inflation again, by the way, especially on wages. Wage price inflation is increasing quite a bit. If you guys are aware, the United Auto Workers have struck against the big three automakers, and they're demanding a 50% wage increase. United Parcel Service negotiated a new contract for their workers, and when you include all of their benefits and stuff, they're looking at salaries of $170,000 a year. Those are things that are going to cause, when those wages come up, that's inflationary in the core of it. So inflation is probably going to start coming back up again. And of course, we've got oil prices sitting at $90 right now, at some highs from. We haven't seen these kinds of highs in quite some time. So, and Russia and Saudi Arabia have kind of implied they want to drive those prices up to $100 a barrel. So, in any event, I think that we're going to see rates higher for longer. And I think the market is finally realizing that the Fed was serious about the longer. And so there's been a sell-off. Stocks right now are way overpriced if you factor into inflation or if you factor in higher interest rates. The stock market is actually overvalued by about 15%, even if you factor in just today's interest rates. So again, a lot of people have been expecting interest rates to come down, and that's why stock prices have kind of come up. But as people realize that interest rates may not be coming down anytime soon, in fact, might actually be going up from here a little bit, stocks have to reprice, and we might see some of the lows we saw back a year ago or maybe longer. So in any event, the market's going to be volatile over the next few months and maybe as much as a year, based on what we know now. So I'm not going to say that it's going to stay that way. My hope is, and again, from the way we trade, I like the higher VIX. So I'd like to see a little bit more volatility. I'd love to see those days. I love those days where we're up 30 points one day and down 40 points the next day. And that kind of stuff is what we live for. But there is going to be some volatility because the market's not happy with what Jerome Powell said on Wednesday. The only other chart I have for you guys is I wanted to compare the year ago from where we're at today in interest rates. Now, remember, I stopped doing it a few months ago because it became a little bit tedious. But let's look at what interest rates or where interest rates are just from a year ago. So if we go back to September 15th of 2022, the 1-year Treasury, and we were all surprised at how high that rate was because that was a really high rate. Now remember, back in 2021 when they started raising the rates, these rates were at 0.25. So 1-year Treasury bond was, very, very low. But by September 15th of 2022, the rates had gone to 3.99.4. So let's call it 4%. Today, those rates, a little over, well, almost 5.5. So we're up 147 basis points. That's 1.47%, by the way, guys. That's a huge increase. This is why if you're a bond investor, you should be shorting bonds. You cannot be long bonds. I think these rates go higher from here too, by the way, guys. There's a lot of reasons. I'm not going to go into them now, but in the bond market is kind of messed up. If you're in the bond market and you need to do something because maybe you've been holding some bonds, especially if you've been holding any long bonds, which is a terrible idea, you might want to use some swaptions those are swap options called swaptions. You can use those to kind of help generate some or recover some of your position if you're upside down in these in bonds. But I think interest rates go higher, so you do not want to be buying rates or bonds. If you are buying bonds, you got to keep the maturity low. So you don't want to go over maybe maybe a 2-year bond, but certainly wouldn't do anything more than a 2-year bond at this point because I think bonds are going to continue to go higher. There's a lot of reasons for it. China's not buying our bonds right now. The government's struggling to find buyers. They put out, every week they're putting out billions of dollars of new bonds, and they're struggling to find buyers on these things, guys. And whenever the government can't find buyers for their bonds, the only recourse they have is to raise the interest rate. So it's entirely possible that you could see a 10-year bond or 30-year bond, going up considerably from here. Now, just a few days ago, we were at 4.5 on the 10-year. 10 years come back a little bit. You can see that here. But let's go through our list here. So on the 2-year bond, we went from 3.85 up to 5.11. So it's 125.4 basis points increase. That's a huge increase. If you held bonds or if you were holding those bonds, if you had bought a 2-year bond, that bond had lost a bunch of money. Now that's if you sold it. If you held the bond, it was still worth par value. So as long as you hold it, and that's why I say if you're going to buy bonds, you've got to hold those bonds because as interest rates go up, remember the value of those bonds go down. So if you sell it, you're going to sell it at a discount to the par value, and you're going to take a loss. And these losses are fairly dramatic here. People are losing 15, 20, and 30% on these bonds just in a relatively short period of time. So keep the maturities, what we call in finance duration, keep the duration low so that you don't get caught in a position where interest rates spike higher and you're losing drastically a lot more money. The 3 years gone from 3.84 up to 4.8. So a 95.6% or basis point, 95.6 basis points, not percent, but nearly 100 basis points there. And remember, 100 basis points is 1%. 5-year bond has gone from 3.66 to 4.55. It's an 89.4%, basis points increase. 7-year bond, 3.85 to 4.52, a 94.3 basis points increase. The 10-year, that's the one that kind of drives the economy, guys. Everything runs off that 10-year. Mortgages, usually add 3% to mortgages to get, 3% to a 10-year bond to get to mortgage rates. So we're approaching potentially 7-8%, that we're actually over 7% on mortgages, but we could be fast approaching 8% on mortgages, which is going to deal a huge blow to the real estate market. Car loans are built off of this too. A lot of them, or some of them, are off a 5-year bond, but again, a 10-year bond and a 5-year bond at these rates, car loans are going to be 18 and 19 and 20%, already are in some places. But we've gone from 3.449, let's call it 3.45, up to 4.438. So again, a 98.9 basis points increase in rates there. And then on the 30-year bond, 3.470 to 4.529, 105.9 basis points. That's a huge increase on a 30-year bond. Remember, the government funds most of their operations with a 30-year bond. And so they're locking in rates of 4.529. And believe it or not, there's a hedge fund guy out there. His name is Bill Ackman. He believes that the rates, the government should be funding more stuff at the long end here instead of the short end, and in the hopes that a lot of what the government generally does is they'll try to fund the government with those short bonds, because right now they do have a higher interest rate than the long bonds, but it's for a shorter period of time, and they're hoping that in the next year or two interest rates will be lower and they can refinance that debt at a lower rate. But he thinks that bonds are going to, or rates are going to go so much higher that they ought to lock in the 4.5% for the next 30 years, because he thinks the 1, 2, and 3 could be significantly above that and stay above those levels for an extended period of time. I don't know that he's right, but again, I'm not a bond investor, so I buy them for my clients and stuff as I need to, but I'm not a big fan of bonds unless you're old and or you're on a fixed income type of thing where you need the income and stuff. And if you need the income, if you're living off of bond income, you're probably not too worried about what interest rates are doing. Of course, you want to lock in a higher rate anyway to get you more income, but you don't necessarily worry about whether rates are going up or down because you're holding the bond to maturity. But again, if you are in bonds, you want to keep the maturities to probably no more than 2 years, just to kind of keep yourself safe. Anything above that, and you're taking a lot of risk, the duration goes up significantly, and duration kind of implies volatility, and the last thing you want in the bond market is volatility. So, having said that, guys, that's all I've got for the week. If you have any questions, of course, you can always email me, contact me, whatever. Other than that, we'll see you next week on the meeting. And for those of you who come to the daily call, we'll see you on Monday, and hopefully we have some good trading on Monday and the rest of the week. Enjoy your weekend, guys.